Welcome to this month's edition of Up to Speed, Baker Tilly's Automotive Industry Podcast. I am your host, Mike.mader, the dealership industry leader for Baker Tilly. On a monthly basis, Up to Speed serves as the automotive industry's connecting point to hear about conversations from industry leaders regarding topics that pertain to tax, accounting, and operations of retail dealerships. We arrive in your mailbox the third Wednesday of every month. If you'd like to listen to some of our past episodes, you can find them at www.bakertilly.com/dealerships. Also, if you do have a topic that you have some interest in or like some additional insight on, please let us know by reaching out to our website. Our goal is to provide you with relevant, up-to-date information that is quick and easy to digest that you can easily watch or listen to on the go. In our July and August episodes of Up to Speed, we discuss some of the legal pitfalls you can encounter in the merger and acquisition market and what you should be aware of, as well as what happens on the real estate side of the transaction that's often overlooked. In this month's episode, we are going to keep up with our M&A theme and discuss the banking side of a transaction and what you can do to maintain and improve your opportunity to successfully get the financing needed to close your next deal. With me today is Jason.w.smith of Truist. Jason is Executive Vice President and Head of Dealer Commercial Services at Truist and has been in the financial services industry for 25 years, supporting auto dealers across the U.S. with strategic advice and solutions they need to navigate the changing industry change landscape and reach their business goals. Jason, it's good to have you here today, and welcome to this month's episode of Baker Tilly's Up to Speed.
Yeah. Hey, Mike. Thanks for the invitation. It's a pleasure to be here with you and joining the Baker Tilly Up to Speed episode.
Awesome. So let's get started. We're going to jump right into it because we got a lot of things to cover on the banking side, and everybody's always interested to find out what's happening in that financing world. So, why don't we start today's conversation kind of with an update on what you're seeing in the banking profession on the automotive industry?
Yeah, sure. So generally speaking, we're certainly continuing to see consolidation within the sector with our clients. That being said, whether you're, in my opinion, growth-minded, you're status quo, or you're looking to prune off a few dealerships from the portfolio, it's probably never been a more important time to understand the trends in financing structures. As you well know, Mike, the industry is changing at a rapid pace, and staying in tune with trends and data points is really important in the current environment.
Yeah, and it's hard to stay on top of that unless you've got people like yourself in the network of financing scenarios to be able to do some of that and keep up with it. So.
Sure, Mike. The dealership sector is coming off some of the best years ever, following the pandemic, and we're well down the road on the, much documented and the much anticipated normalization of margins and dealer profitability. That being said, in my opinion, the future remains very bright for the automotive sector. Dealers really need to prepare for short-term market conditions and factor in longer-term moves to secure the business for the next gen, the current generation, and more importantly, to maximize the enterprise value of these family-owned businesses. So, whether you have aggressive growth plans or you maintain the status quo, it's important to have a well-thought-out financial projection model. And when I use that phrase, Mike, a financial projection model, I'm referring to a multi-year forward-looking financial model, and that includes stress testing possible outcomes. And that puts the dealers in a better position to act quickly on the acquisitions that you talked about earlier in your question. Ownership transitions, whether that's minority owners or full transitions to sell in totality, or just general external events, whether it's sector related or outside of the automotive sector from that standpoint. So what we're doing, Mike, is we're devoting a large amount of our time and a lot of our internal resources to work hand in hand with our clients on developing what we'll call is a highly customized multi-year projection model based off of the past performance of the dealerships and then a forward-looking view of where the dealership group is heading.
So, Jason, you say multi-year projection models. When you say are you looking at a 2-year? Are you looking at a 3-year, a 5-year projection? What is the bank looks, or what do the banks look at right now as far as how far out they go? Because they're obviously, there's a lot of volatility within the auto industry.
It is, and that's a good question. It's difficult to project in general. So the further you go out, the difficulty rises just with some of the uncertainty. It's really the latter part of your question. We're looking really for a 3 to 5 year horizon, probably closer to 5. You can be a little bit more nimble on years 1 and 2, and then when you get 3, 4, and 5 out, it's a little bit more challenging. But we look over a 5-year horizon typically.
Okay, so dealers are usually very optimistic. So do you sometimes have to calm them down as far as, hey, you know what, you're growing 60% over the next 2 years and another 50% after that? Do you have to kind of tailor those models for them?
It's a good question. So it varies, right? So it's really everyone gets their opinion in the room. So we have a set of assumptions. Our dealer, the CFO, and the owners have a set of assumptions, and we can work on different scenarios. One could be a little bit more optimistic, to your point. Another scenario could be more status quo. And then the third one could be what we'll call a through the cycle. I think we all can agree that this could be a cyclical type sector, retail consumer, if you will. So it is prudent to work on a through the cycle or a stressed or down cycle scenario, but you can have all three and see what the different outputs would be if you look at it over that horizon.
Okay, perfect. So you've been working with dealers for over 25 years. So what advice can you provide them when they're working with their professional advisors, primarily bankers? I mean, what are some of the things that you look for in your relationship with the dealer?
So Mike, that's a great question. I truly believe that what you and I are doing in our seats and in the roles that we hold within our respective firms, that we're in the relationship business. And we're also providing highly technical expertise and capabilities to our clients. Given the sheer complexity of the auto groups and the rapid changes that we just talked about that are occurring within the sector, it's important for dealer owner operators and other C-suite members within these organizations to develop and maintain really deep relationships, not only with their bank, but it has to be the CPA firm, the financial partner, the banking partner, as well as legal counsel, and working jointly with what I'll call your third-party professional partners versus working with them in a silo or independently is key, in my opinion, when you can have all three of those organizations working in lockstep for the dealership organization. To answer really the second part of your question, what I enjoy most about the sector and working with clients is those deep relationships. And I really enjoy, my team enjoys having very frequent, substantive, and open communication about the family's business. I like to start with, where do you want to take your organization? What are the core objectives and strategies? And then you solve from there. And if you have a really good understanding of where the owner operator and the CFO want to take the business, then that's when you can come up with really good guidance and thought leadership to help them try to go on that journey.
That's awesome. I think it's great that you made the comment on how the banks, the accounting profession, and the legal profession all really need to be working together, because any change in any of them affects the others, and that communication has got to be open all the way through.
I agree.
So with respect to financing of an acquisition, how are banks looking at blue sky financing today? I mean, are there things dealers should be doing better? Things that they should be doing that will better their chances of getting either some or all of the blue sky financed, or how do you look at it?
Yeah, it's interesting, right? With the level of M&A that the sector's had, that you've been involved in, that we've been involved in, and it seems as if that will certainly continue for the foreseeable future. I like to think about it, and how we view it within our organization is the holistic capital structure. And so when you think about the cap structure of a new franchise auto dealership organization, you have, in its simplest form, you have the floor plan, you have the commercial real estate, the land and building, and then you have the blue sky, and you could certainly add the working capital there as well. That's the hierarchy. And so when we're looking at structuring acquisition financing, we look across the entire landscape, all three of those pillars. And if you take the step back, you certainly can have equity in all three. The real estate is one of the more patient forms of capital. You typically could have a little bit longer of an amortization than you would for what I'll call undersecured or blue sky acquisition financing, which has a little bit faster of an amortization. And then the floor plan, I think we all know how that aspect works. But when you take components of all three of those, of the capital structure, that certainly helps to structure the acquisition growth capital needed to consummate the acquisition at hand. So we're looking across the entire landscape. There's certainly an appetite, and there's capital available to help continue to fuel the growth. But that's really the lens that we're looking through when we're structuring and providing growth capital to our clients, Mike.
Okay, so you're preferring to have all of it, I'm going to say, because a lot of times, sometimes the real estate is financed separately, which then you've got, I mean, I look back to Warren Buffett's comment on Bitcoin. He doesn't want to, he never will buy any Bitcoin. He won't give you 25 cents to buy Bitcoin, but he'll give you 25 million to buy real estate because it's got that collateral. You can touch it and it's tangible. So if you guys had the opportunity to come into a transaction and get the working capital and the blue sky component of it without the real estate, how does that change things?
Yeah, that's a good question, and I do want to acknowledge that Warren Buffett, one of the greatest investors of all time, and one of my favorite books, Mike, is the Essays of Warren Buffett, and I try to read that at least probably once a year. It's a great read. But getting back to the core of your question, from our perspective, being the primacy, if you will, having the ability to assist the clients across all of their needs. So when you're thinking about the procurement of capital or the debt side, having diversity in the different credit facilities, floor plan, real estate, blue sky, certainly assists when you're looking for more growth capital because you have different collateral types and different structures for those from a banking standpoint. The same could be said when you're thinking about the non-credit side, the depository, treasury, merchant. All of that kind of goes hand in hand when you're trying to structure what I'll call a holistic solution for an organization that's looking to grow, scale, whether it's a dividend recap, whatever it may be. Looking across the totality of the business is pretty important to us.
Okay, so we talked a little bit earlier about the communication between the accountants, the attorneys, and the bankers, and what a client needs to do. So this is where it really becomes true, is when in the accounting profession there are a lot of changes that happen, some that affect the financing side of stuff, and one of them is the covenants. So there could be an accounting pronouncement that doesn't make sense to the ordinary world, but it does to the accounting world, but it messes up how the financial stuff works. So when you guys are looking at covenants in the dealership portfolios, how do you guys handle these changes or look at these changes in the pronouncements?
Yeah, it's interesting because some of these groups have become, the organizational structures. There are a lot of boxes and arrows. They've become more complex. You talked about real estate in your prior question. Is the real estate on balance sheet? Is it off balance sheet? Is it leased? Is it owned? Are we looking at EBITDA? Are we looking at EBITDAR? And so as you go through, all of those elements I talked about, I think the best way to look at it is to take a big step backwards, look at the organizational structure of the relationship at hand is point number one. And then we look at the capital structure. How do the monies flow? Is it a management company or a hold company at the top of said org chart or not? And then we once we have that understanding of the structure and the capital structure, then we start to back into how do we put in covenants that make sense
Okay.
from the simplest sense to view it that way. And if you just think about the income statement or the balance sheet, or we talked a lot on this episode about acquisition, financing and growth capital, logically so given what we're seeing in the sector, maybe let's explore some of those. So the income statement, when you think about some type of financial covenant structure, it's probably going to be some type of debt service coverage structure on the P&L, if you will. Looking at the balance sheet side of the equation, it's more than likely going to be some type of floor plan trust equity. Another vernacular or nomenclature may be vehicle trust equity, or simply just trust equity. Those are just different phrases for really the same thing. What is the equity in the floor plan collateral type, if you will? Or you could look at working capital as another way to get there. And then when you think about acquisition debt, not new to other sectors, it's a little bit newer to the larger organizations in the automotive sector, is simply cash flow leverage. And when you're thinking about cash flow leverage, that does exclude the floor plan. So you're looking at total debt as a ratio to EBITDA or EBITDAR, not including typically the floor plan in that total debt. You back that out because you've covered that with the trust equity that we talked about a little bit earlier.
Okay, great. So I'm going to ask you one more question. I'm going to kind of put you on the spot here, and people are going to test you on this, Jason, because on the 17th of September, the Fed is going to either increase rates or keep them the same. I don't think we're seeing a decrease, but you've probably heard this 1,000 times over the past 90 days. Where do you anticipate interest rates are going to go and how quickly?
That's a hot topic for sure. And we'll see if I can chin the bar and pass this test. So as I was starting my day today, listening to some of the talking heads, this was the topic of the morning, and maybe rightfully so, just given all the various dynamics. So I'll take a stab at it, Mike, and then you can give me a grade after the Fed meets, and we'll see where I landed. But the futures for next week are trending more to show about a 50-50 chance that there'll be a 50 basis points rate cut. I'm personally of the view that we'll only receive a 25 basis point rate cut next week, but we certainly could see that accelerating to 50 basis points in subsequent meetings. On the 17th of September, we'll see the retail sales number, so we'll obtain the latest read on spending the day before, to your point, that the Federal Reserve actually has the announcement next week. So CPI data was at 2.5% earlier this week, which is a new low, but it's still not quite at 2%, which is the Fed's target. Kind of looking out past this calendar year going into next year, futures show rates getting down to around 3% in 12 months. So that's basically 25 basis point rate cuts in short order. My view is that seems pretty fast, and that may be hard to achieve unless one's thinking that there'll be a recession. So hopefully that gives you some insights, but those are my opinions, and we'll see where that lands as early as next week.
All right. Well, we're going to be together in a couple of weeks again, so we'll discuss how you graded on that one then. So, all right, that concludes this month's episode of Up to Speed. Jason, thank you for giving us some insight in the automotive industry from a banker's perspective. And to our audience, we want to thank you for joining us today. And if you have any questions for Jason or would like to discuss the opportunity of doing some financing with Jason, his contact information will display on the screen. So feel free to reach out to him directly. So Jason, I want to thank you for joining us, and it was great insights.
Hey, Mike, thank you. I enjoyed the discussion. It's always a treat to spend time with you, and I'm really grateful for the opportunity from you and the Baker Tilly team to join the Up to Speed episode. So thank you very much.
Awesome. So we look forward to seeing you in our next Up to Speed episode. And remember, we arrive in your mailbox the third Wednesday of every month. And you can also visit our website at www.bakertilly.com/dealerships to view our past Up to Speed episodes. Until next month, make it a great day.